There's a company growing revenue almost 47% a year. Its e-commerce arm processed over 4 billion orders in a single quarter. Its fintech arm grew 58%, and its gaming division made over $570 million in profit in just 3 months. The whole thing is profitable, and there's more than $1 billion in adjusted EBITDA, and the whole entire company is just valued at $63 billion total because the market is looking at this completely wrong. So last video, if we can recall, I talked about buying what the market is too scared to currently look at. And this is that idea taking global because most people are buying American companies and this is not that. And that is precisely why it's mispriced. The stock is C Limited and it's priced right around $113 per share as of today's trading session. And one of the greatest macro traders of our time, Stanley Druckenmiller, just increased his position again. And hopefully by the end of this video, you're going to understand exactly why he did it. So here's the setup. American investors for too long have been trained to believe that the best tech investments only come from the US. E-commerce means Amazon, ads mean Meta and Google, payment processing means MasterCard or Visa, AI means the US hyperscalers. Now, don't get me wrong, these are great businesses. But what happens is that everyone is so focused on them that the trade becomes crowded and the rest of the world gets left behind. Meanwhile, Southeast Asia has become one of the fastest growing digital economies on the entire planet. And that is so important because there's nearly 700 million people there. And their economy is young, mobile first, and currently still growing their middle class. And for some perspective, its digital economy in 2025 had more than $300 billion in GMV. That's up more than sevenfold just in the last decade. But penetration in commerce, credit, and payments is in fact nowhere near US levels. Now, the beauty of this is C sits right in the middle of that, and the platform already exists at scale. And so you're not betting that the infrastructure gets built out. You're just betting on that the current market environments around it keep growing and monetizing. So quick question. Before we go any deeper, I want to know if anyone owns any equities outside the US. I'm curious to see who's actually truly diversified. Feel free to comment the names down below. So to understand C, you have to understand the breakdown of the businesses. And C has three businesses. First, they have Shopee. This is just their e-commerce arm. It spans across Southeast Asia, Taiwan, and Brazil. Second, they have Money. And this encompasses payments, consumer loans, and buy now, pay later products. And third, they have Garena. And this is the gaming business behind Free Fire. And first, when people usually look at C, they do it the lazy way, and that is to see three separate companies. But I'm here to tell you that they actually all feed each other. So Shopee pulls in consumers and merchants, and every purchase, search, and payment creates more data. And the beauty is, Money then uses that data to underwrite people for credit that the banks can't even evaluate themselves. And it's so cool and unique because it sees your actual shopping and repayment behavior and not a thin credit file itself. And that credit actually makes Shopee stronger because it gives buyers more credit and spending power. And Garena pays for nearly all of it. It produced nearly $574 million in adjusted EBITDA just last quarter. And the crazy thing is that's not a retailer. That's an integrated ecosystem. So think Amazon, PayPal, and a major game publisher all in one, all the while the markets around it are still growing. Now for some more proof, we'll look at their quarterly numbers. So just last quarter, C did nearly about $7.1 billion in revenue. And that was in Q1 alone, up 46.6% year over year. Now their gross profit also was up 40% to nearly $3.15 billion, all the while their operating income was up nearly 30% to $593 million. And on top of that, we can see that their adjusted EBITDA increased by 9.3% year over year to roughly $1 billion. And then their net income also came in around $438 million. So this is a monster quarter for a company that still has a ton of growth ahead of it. And perhaps what's most important is that this isn't a company torching its income statement to grow. It's growing fast and profitably at the same time, which is extremely rare to find in the smaller to mid-cap companies. Now for some other highlights. Shopee processed nearly 4 billion orders, which was up 29% year over year. And their GMV came in around $37.3 billion for the quarter, which was super impressive because it was increasing nearly 30.2% year on year. The revenue here was up 45% to nearly 5.1 billion, and their core marketplace revenue, which was fees and ads, was up 61% to nearly $3.8 billion. Now, this next part is very important. So the adjusted EBITDA came in at $223 million in this branch. And you can see it was down from $264 million a year ago. And naturally, this is a number that bears will jump on. But it's important to note that that dip is actually deliberate spending on logistics, customer acquisition, and not actually collapsing demand. And so management themselves still guides for about 25% GMV growth in just 2026. Now I wanted to move on to money quickly because it might be the most underrated piece of the entire puzzle. So the revenue is actually up 58% year over year to nearly $1.24 billion. The adjusted EBITDA was up 14% to nearly $275 million. And the loans outstanding nearly hit $9.9 billion, which is up a whopping 71% year over year. And the loans more than 90 days past due, which is extremely important in this type of business, stayed flat at nearly 1.1%. So what's extremely impressive is you have a growing loan book that fast without asset quality actually cracking, and that's the entire story. And now it's even expanding beyond Shopee and into Brazil. Garena came back extremely strong. Their bookings are around $931 million, up 20%. The revenue was up 40% to nearly $697 million, and their adjusted EBITDA was up 25% to nearly $574 million, which was over 61% of the bookings. We can also see that paying users were up 12% to nearly $73 million, and the pay ratio rose from 9.8% to 10.9%. And it's important because it didn't necessarily need explosive user growth, but it got more users to pay. So now you have Shopee growing, you have money growing, you have Garena growing again, and all three are adjusted EBITDA positive. That's a completely different sea than just a few years ago. So now for the most important part of the video, I wanted to walk through the valuation of this company because it's a bit tricky to evaluate it. So at $113 a share, C is worth about $68 billion. But the important thing about a company like this is you can't slap one multiple on the entire thing. Because you have Shopee growing, you have money growing, and you have Garena growing, and they're all completely different businesses. So Shopee, as we know, is an e-commerce, ads, and logistics service where money is more financial services, and that's going to be judged on loan growth and credit quality and long-term profitability. And then you have Garena, which is high margin gaming. So then we value them separately and add them up for some of the parts method. Now, for the most important part, which I wanted to just touch on, is the valuation analysis. And you can see that we did it in 3 different ways, which should be very, very accurate for this kind of company. So you obviously have the DCF breakdown here, and they had very strong free cash flow. Analysts were targeting around 4.16 billion in free cash flow for just 2026, and growing to 4.37 billion and then to 5.2 billion over the subsequent 2 years. So before you apply a 5% growth rate in years 4 and 5, we wanted to really adopt that kind of long-term, more conservative growth rate of 3.5%, which you view as more of an appropriate multiple given the historical free cash flow of 83% and the revenue growth of approximately 40% CAGR over the past 5 years. And so what we can see is our DCF comes out to a nice price target of $196. From when we did it, it was currently at $96, which was 100% upside roughly. Now it's trading at around $113, which is very nice for a thesis, but the upside is still around, 60 to 80%. Our EV to sales multiple, we slapped on 2.4 times, and that gave us a lower price target, but still upside of $139. And I just wanted to further show you how we got these multiples. So as you can see, some peer competitors, you have Mercado Libre, which is a very strong company trading at roughly 3.7 times. And you have Grab, right here at roughly 3.1 times. And so given that peer set, we felt that it was appropriate to adopt a forward multiple of 2.4 times, which gave us, again, that $139 per share. And then here's the breakdown for the EV to EBITDA multiple. We got 17.3 times, which is well below the 12-month average of 25 times. And, a forward multiple here appears reasonable at 19 times when you consider their benchmark peers. You have Alibaba at nearly 23 times, you have Mercado Libre at 25 times, and you have JD.com at nearly 33 times. So we definitely took a more conservative approach. And as you can see, even at a conservative approach, you still have the $133 per share in the EV to EBITDA model breakdown. So there's definitely a lot of room for upside, and C looks very attractive even from these levels. And now after breaking down the valuation and the analysis, you can see my key point. And that is, you don't need every part of this company to go extremely well for this stock to work and to re-rate higher. So C already owns three valuable and very profitable businesses. Its Shopee can hold its growth and slowly improve margins while Money expands and keeps credit losses under control, and Garena can stay a durable cash machine, then the value should be well over $68 billion. And with that said, the upside can become substantially higher if AI can monetize faster than expected, or if Money succeeds off Shopee, or if Brazil can become another second major market. So if you want our sum of the parts model and the bear, base, and bull case on all three businesses, it's up on our Patreon. But the main thesis of the entire video is right here. So I mentioned that AI could be a huge uplift and a growth lever for SE, but I wouldn't directly value SC as an AI company itself. But with that said, AI improves almost every part of it, and it's already showing up in the numbers. AI upgrades in Shopee search drove a near 14% jump in purchase conversion, and a whopping near 80% of customer queries are actually handled by AI chatbots, which drove a cost-cutting and savings of nearly 30%. And so the real AI moat is the data, the real searches, the purchases and repayments across many countries, which actually feeds better recommendations, fraud detection, and most importantly, credit underwriting for inside money. And obviously at C's massive scale, even small improvements can turn into big money. And perhaps the most exciting thing about being a C shareholder is who you're a shareholder actually with. And look no further than Stanley Druckenmiller. His family office held nearly 944,000 shares of C at the end of 2025. And in Q1 of 2026, they raised it to roughly 1.1 million. And this was up around 16.5%, which is roughly $91 million. Now, I normally wouldn't tell you to buy names just because another super investor like Stanley Druckenmiller is, but the numbers and the themes and patterns are definitely telling, because he owns names not only here, but in Brazil, Argentina, and other international exposure. So he's clearly hunting for alpha outside the crowded US trade. Now, C fits the bill absolutely perfectly. You have emerging market consumption, you have payments, you have gaming, you have credit, and you have AI, but with real positions and real profits. So like I said, his stake is not the reason to own it, but it is confident knowing that one of the best macro traders of our time sees the exact same thing we do here at TLI. And now lastly, I just wanted to walk through the risks because any good investment still has risks. So the first one is competition. So Shopee fights TikTok Shop, Lazada, and Mercado Libre, but it's important to note that all of those names actually still burn cash on subsidies. So the second risk is that those investments have to pay off. Sales and marketing jumped nearly 50% last quarter, while Shopee's EBITDA actually fell. So we definitely need to see it turn into retention and margin. And now for the third risk, and that is Money's credit book. So loan growth over 70% is extremely aggressive, and provisions for those credit losses actually rose 65% in the quarter. And with that said, credit losses can actually lag loan growth, especially if the economy turns. So all in all, that would be the biggest downside risk. Now, importantly, none of these risks kill the thesis, but you're going to have to watch it for Shopee, GMV, monetization, and EBITDA, for Money, which would be loan growth, provisions, and past due loans, and then for Garena, which would be bookings and user growth. So all in all, when we step back, SE is one of the strangest combinations in public markets. It's growing almost 47% year over year. It has adjusted EBITDA of nearly $1 billion. It's profitable, and it's only valued at $68 billion in market cap. Shopee owns the consumer, Money owns the financial relationship, and Garena is paying the bills. And the best part is, most investors are still valuing it like a volatile regional e-commerce stock. And personally, I think they're missing a far bigger, far more valuable business, which is perhaps one of the best opportunities in the entire market right now. So of course, this is not financial advice, and it's important to do your own research. But if this changed how you see C Limited, then feel free to subscribe and put in the comments, are you bullish or are you bearish on C?